Welcome back to the InvestTalk Classroom. I'm Justin Klein.
I'm Luke Guerrero.
And today we're going to talk about index construction and benchmark selection, which sounds kind of boring, but in today's world where so much money is just flowing into these indexes, I think it's very vital to make sure that you understand how these indexes are constructed so that if you're investing in any of them or you're benchmarking towards them, you know exactly what you are focused on or what you're invested in. Now, Luke, there are different types of indexes and how they're constructed. So why don't you give the audience a kind of a breakdown of how that works?
Yeah, of course. And like Justin said, this tends to be a dry topic. I can feel you nodding off through the screen, but just stay tuned because this is important, like Justin mentioned, because benchmarks and indices is not just how you should judge the performance of the market, but your overall performance as a manager of your own investments and maybe anyone that you pay to manage. So, like Justin mentioned, there's price weighted indices, there's market cap weighted indices, there's equal weighted indices. And it's important to dive into each one because depending on how your benchmark is constructed, it'll have a different opinion of how the market is going, right? Right,
yeah.
Justin?
Yeah. And the most common one is going to be market cap weighted indices. And that's the S&P 500. And it basically means that the bigger the company is, the bigger the value is of that company, the bigger percentage of the index it is. So what happens often over time with these indices is if a certain part of the market tends to do very well, suddenly if you're invested in the index, you have a large exposure to that part of the market that has done very well. And it could continue to do very well, or it could crash and burn like the dot-com bubble 1.0, where the vast majority of the indexes were tech companies and their valuations dropped 70-80%. And that can be a big problem if you are overweight those sectors that are suddenly not doing well when in the past they had been doing well, right?
Exactly. And just as important as the methodology behind what weighting you give a security is how you select those securities. You mentioned the S&P 500, which is probably the most popular index that most people track. And that is an index selected by committee, right? Mm-hmm. So you have a situation right now, for example, halfway through 2023, where the performance of the S&P 500 is primarily driven by a handful of names. Mm-hmm. There's a different type of index, the Russell 3000, which also measures US market performance. And that's selected by a number of names approach. They just take the 3,000 largest names in the US, right? So that's more inclusive. So in that situation, maybe the Russell 3000 is a better way to judge how the US market is performing rather than one selected by committee.
Now that brings to the question, is indexing really passive, right? A lot of people call indexing when you're investing in these indexes passive investing. And I think it's passive on the investor part, but because of that rebalancing, in a way, it's actively managed, right?
Yeah, no, the S&P 500 is a good example, right? That is decidedly actively managed. Mm-hmm. There's a committee that selects what goes into it. The Russell 3000, maybe not so much. Mm-hmm. The Russell 3000 is just a pure number of names approach. Yeah. But when you get into the style indices within the Russell 2000 value, for example, they're going to make selections based on criteria of what's going to go in there.
Yeah,
right?
What is considered value and what is considered growth.
Exactly.
Right?
And what I consider value might not be what they consider value, right? I know there was a situation last year when, because of how they judge value on a sliding scale, you had names that were oil and gas names that were trading at ridiculous multiples, included in that index. Mm-hmm. And that doesn't just happen when it's selected, but also over time, right? Because these indices rebalance in set periods.
Yeah, and GameStop's a good example, right?
GameStop's a great example because the Russell is going to rebalance in June of every year.
And the Russell's the Russell 2000 small cap index.
Yeah, the Russell 2000 value is a small cap value index. Mm-hmm. And when they rebalanced, GameStop was in there. Mm-hmm. And you had that huge run up fueled by the Reddit mafia, if you will.
Gotta love the Reddit mafia.
The Reddit mafia, which, drove up the price of GameStop. And by January, February, it had peaked. But it was decidedly not a small cap value name, but it's still in the small cap value index.
Yeah. And because these typically rebalance quarterly?
Well, the Russell rebalances annually.
Annually. Okay. Yeah. So what happens is you can have big movements like GameStop and suddenly it's a big part of the index. And if you just happen to buy the Russell 2000 value index at the peak of GameStop, right, then you were suddenly very exposed to that downdraft, and now GameStop is no longer soaring to new heights. It's basically crashed, right?
Exactly. And if you're still with us, if you're still awake, you may be asking yourself again, why is this important? And it's important because indexing has become probably the most popular way of investing in the market.
Mhm.
And just as we always say it's important to know what you own when you're buying individual stocks, it's just as important to know what you own when you're buying an index.
Yeah, and a lot of robo-advisors are investing in index. That's what they're doing, right? They're just putting you into typically ETFs or index funds of some kind, and you need to know what you're invested in. And it makes their job easy, right? They're just allocating to some sort of algorithm. But ultimately, it's your money. And when your money is invested, you need to, like you said, know exactly what you're owning. Now, one of the most common indexes is the Dow. The Dow is 30 names. It's only 30 names, and it's price cap weighted, which I think is always very interesting. And that's why, us professionals, we don't really follow it, but it's a big number. So people, say the Dow was up 300 points, it was down 500 points. It seems like a big number. It seems like a bigger impact than the S&P being up 12 points, right?
Exactly.
So, but we never look at it because it's price cap, meaning when a company decides to split their stock, like IBM, right? That is going to have a huge impact on the weighting of IBM within that index. So I think price cap is something you definitely need to know about, but most indexes besides the Dow are not price cap weighted, right? Yeah, and so when you're building a benchmark, and like you said, a lot of people benchmark their portfolio. How did the S&P do? How did I do? Well, that's typically not a great benchmark because most people aren't just in large cap stocks, right? They have some mid caps, some small caps, maybe they have some foreign names, and maybe they have some bonds in their portfolio, maybe they're carrying a lot of cash. So it just depends on the construction of your portfolio, and based on that construction, then you can benchmark how well you're doing, right?
Yeah.
So I think that does it for this episode of InvestTalk Classroom. Thank you for tuning in, and we'll catch you next time.